Hi, this is Lance Lamb representing Group 3 in the Cola Wars presentation. We're going to jump right into this and get started. So we looked at the historical profitability of the industry with respect to five forces from Porter. So we start with the industry rivalry was weak for a long time. Coke basically dominated the market. Pepsi really struggled for years to gain any market share, actually went through a couple bankruptcies. So a lot of profits for Coke early on. Raw ingredient suppliers really had no control over pricing, another weak force, so opportunities for profits. The buyer power, bottlers were small, independent. Also, grocery stores and soda shops, they didn't have a lot of say in what the price was going to be of the end product on the shelves. So that gave the concentrate producers an area where they could really capitalize and be profitable. Also, a lot of weakness in terms of the threat of new entrants. This was a capital-intensive industry. You had to have a pretty sizable production plant, and your distribution costs were very high to get product delivered. So that, again, created more profits for those who were in the industry. Viable substitutes, there were some in terms of the options like Dr. Pepper in terms of the flavors. I mean, juices, waters, they were always available, but really trademark protection was in place to help the concentrate producers. There was also a lot of brand loyalty developed through marketing campaigns. So a new soda might come along, but it was really hard to get into that market and gain anything. We also looked at how the profitability changed with respect to the five forces. Later in the 80s, the industry rivalry grew a lot stronger. Pepsi came around, gained a lot of ground through their restaurant affiliation through the fountain side. And the marketing campaigns challenged the loyalty to brands. So that created some opportunities for Pepsi to gain profits and actually cut into Coke's profits. Another area, buyer power. It was more in the restaurant chains, some of those fountain agreements, as well as the grocery stores, just had more command over shelf space and kind of cut into the profits a little bit, mostly for bottlers in terms of the grocery chains. And then individual consumers really had the same amount of control, which is none. Viable substitutes, this is most recently where the push for healthy and more pure drinks, big concern with the sweeteners used in sodas. So that's cutting into the profits that the companies can have. Just to compare kind of profitability between the concentrate producers and the bottlers, which of the five forces really gave who the leg up in profitability. So in terms of rivalry, neither really had a lot to gain profitability-wise from the rivalry. Yes, the rivalry helped raise demand overall between Coke and Pepsi, but it also drove up marketing costs for both sides. The rivalry actually made it less profitable for the bottlers, resulted in a lot of acquisitions and consolidation later on. Concentrate producers, they had the advantage in terms of suppliers. The raw ingredient suppliers had little or no say in controlling price, but the bottlers were subject to what the concentrate producers had to say. Also, their costs were a little bit higher in terms of the cans and bottles for actual distribution. So a profit advantage went to the concentrate producers in terms of suppliers. Buyers, again, the concentrate producers had the edge. Bottlers had to cater to the restaurant groups and how to deliver there. They also had to negotiate more of the shelf return terms for the grocers. The concentrate producers could tell the bottlers whatever they want, and eventually when the bottlers couldn't keep up and started to close down, it led to acquisitions, consolidation, and eventually the concentrate producers owned the bottlers. New entrant threat, really gains for profits on both sides. Trademark protection, brand loyalty really helped the concentrate producers capitalize there. On both ends, distribution costs were pretty high. Plant costs were very high, a very capital-intensive market if you were trying to get in as a new entrant. And From a substitute perspective, nothing really replicates the taste of Pepsi or Coke, and the habits of customers have been established, and the marketing campaigns have really just hammered in and solidified brand loyalty. And really, from a bottling perspective, is there any other way to deliver soda to the end consumer? We don't think so. From competition perspective, how did this really help or hurt profitability? Well, on the one hand, the rivalry made marketing expenses go up. Both sides had to spend more. But the contrast to that is the market demand overall was boosted. The unique marketing campaigns challenged brand loyalty, strengthened brand commitment after a Coke drinker maybe tested out Pepsi for a while. So really, the rivalry probably helped increase profits overall. Price wars in the 90s made some big impacts, mostly for the bottlers. The concentrate producers could push their terms on the bottlers. That led to a lot of failures, a lot of consolidation and acquisitions. And in the end, what that did is, as the grocery industry grew, that created kind of a synergy for these conglomerates of concentrate producers and bottlers. They could negotiate better terms, better shelf space, really didn't have to fight with the low-end name brand, off-brand grocery store lines of sodas. So, and again, the brand loyalty, the sub-brand loyalty through these marketing campaigns, the private label drinks, Sam's Choice, Shasta, Pepsi and Coke didn't have to compete on price. They had the advantages, and grocers wanted to put Pepsi and Coke in premium shelf positions because their profits were higher. So what can they do to maintain these profits over time? Focus on your cash cow. Feed your carbonated soft drinks, even though they're unhealthy, even though everyone's concerned about it. You get bigger margins for retailers. They want them on the shelves, and customers are loyal. They're not going to be switching just because they're a little bit concerned about their health. We suggest some heavy market research to stay on the edge of these market changes, especially when it comes to the non-CSDs. There's small companies, startups out there who are bringing in non-CSD drinks. Find out who's the best, find out who's cutting edge, acquire those, help them gain profits by leveraging through your existing bottling and distribution. And again, your brand image and your brand name is so strong, you need to tie that to these new brands that you're acquiring or developing. And lastly, international is where we see the biggest potentials. CSD consumption is lower outside the United States than inside the United States. We need to boost that consumption with better marketing, more targeted marketing. And again, as we, as Coke or Pepsi, try to gain some growth in the non-CSD drinks, these juices, these vitamin waters, those kind of things, we can distribute those worldwide. We can boost growth in those as we develop them. So that's kind of our target for sustaining future growth.